If your AR looks fine until the owner asks why cash is down, yeah, that's the trap. Let me show you a clean accounts receivable month-end close process that doesn't lie to you. I'm a US CPA and I review AR every month for multiple clients. You'll learn what to log down before close, how to tie AR to the GL, how to spot bad aging fast, what proof to save for review, steps, freeze the cutoff, confirm month-end date plus shipping service cutoff, run AR aging plus open invoices, scan for old stuff, tie AR subledger to GL control account. If it doesn't tie, stop, review unapplied cash credits, clear or explain, check credit memos plus write-offs for proper approval, look at big swings versus last month. One client had $40,000 in AR that was really a duplicate invoice batch. Aging looked scary, GL was overstated. Example, another had payments sitting in undeposited, unapplied, so AR was inflated and cash looked low. What I look for? AR aging totals match GL. Big past due balances have notes, plan. Unapplied cash isn't masking real delinquency. Credit memos aren't used to plug revenue. Cutoff makes sense with shipments, services. Docs that should exist. Aging report, tie out, list of unapplied items, approvals for write-offs, credits, top 10 customer detail. Checklist recap. Confirm cutoff date. Run AR aging. Run open invoice detail. Tie AR to GL. Review unapplied cash. Review credits, CMs. Review write-offs. Top customer balances. Past due action notes. Save PDFs, screenshots. Drop a comment with your biggest AR headache. If this sounds like your close process, you're not alone. Like plus subscribe if you need a review first structure. That's what systems like Xenett support. Review findings first, then resolution.